Hey there, Chris Middleton here with the Make Taxes Fair team, and we're here today live and unscripted. I do have a presentation I'm going to share, but the whole intent of today is to talk about what is a deduction, right? What is deductible, and what's a write-off? So I want to launch into this. Just if you're watching this on YouTube, or this has been shared with you by a friend, again, I'm live and unscripted here. This is recorded as part of our what we call Launchpad series inside of our Make Taxes Fair community, hosted on the school platform. So this is going to be in our free and our VIP community, but you can find out more about those at maketaxesfair.com/community. And if you're in the community watching this, sorry for that little plug there. Reminder, friends don't let friends overpay the government. So share this community with your friends. Okay, I'm going to share my screen now and we're going to launch into the material. So today we're talking about what is a write-off and what's deductible. Now I am going to be focusing in on the Schedule C, because that's kind of the baseline for business when you're starting out. But these topics or these concepts generally apply whether you're a C Corp, an S Corp, an LLC, broadly speaking. So with that, in that respect, it's important to note that today we are broadly speaking, right? This is general education, not meant to be legal or tax advice. Viewing this does not create a client relationship. So we advise you to consult a tax professional for information about you. Okay, so let's talk about the math behind a write-off. So if we have $1,000 deduction, right, and that means a tracked, documented business expense, the regular income tax, right, it's going to give you regular income tax savings, and if you're a sole proprietor, 15.3% self-employment tax. So on average, assuming you're in a lower bracket, right, you're looking at $1,000 deduction saving you, let's say, $300, give or take. And it's an important reminder to remember that you're taxed on your net revenue, not your gross revenue. Untracked expenses are just voluntary deductions to the government. And if you're in business, it's important to know, like, everybody's like, well, I made $1 million. You know, if I had $1 for every time somebody told me that, I'd have $1 million. So, you know, people come and they're like, oh, I made $1 million. I'm like, cool. What was was that your net? And they're like, no, I made $1 million. I'm like, oh, you grossed. Your total revenue, your top line revenue was $1 million. You didn't make. So after all your write-offs, what was your take home? Well, I only made 50 grand. Okay, so you made $1 million, but you only kept 50 grand. That's what that 50,000 is what you're taxed on. So that's important to know, right? And to understand. The other thing about business write-offs is to qualify as business, they have to be ordinary and necessary. So ordinary means common and accepted in your industry, right? So if we're looking at a gym owner, right, gym equipment would be ordinary, right? And necessary, is it necessary for your business, right? Is it necessary for that to be paid for and an expense for your business? So, you know, gym equipment, absolutely. Family vacation, as much as you want to argue, I need that for my mental health. Sorry, the IRS says, hey, great, not everybody has a family to go on vacation with, or, you know, family vacation is not directly related to your business, right? So you got to be aware of the ordinary and necessary filter. And generally speaking, as long as it genuinely helps your operation to grow or protect your business, it could pass the test. So just remember, stop sharing my screen. Warren Buffett, I think, is the one that said this, you know, pigs get fat, hogs get slaughtered. It's okay to have write-offs. We want to track our write-offs, but we don't want to be greedy. We don't want to be taking things that are not legitimately business deductions or related to the business, okay? The next kind of key thing here is we want to understand deductions and tax credits, right? So deductions and tax credits are very different. Deductions are a mechanism that lower your income. So again, if you have $1,000, if you have $10,000 of income and you have $1,000 deduction, you've lowered your income by $1,000, right? So the power of that is it saves you 20 to 30% ish on your tax bracket and self-employment tax if you're a sole proprietor. So the control that a business owner has over deductions and write-offs is very high, right? You can track your expenses. You can be more diligent. You can say, oh yeah, I want to spend money on the business I'm going to reinvest in the business and equipment or whatever so you have a lot of control over that to control how much of those you get or don't get. You can be very frugal and spend nothing on the business and say, I'm just going to live on all that, which means I'll be taxed on all that potentially. So it's important to understand that. Tax credits, right, is a mechanism. The mechanism is a dollar for dollar reduction of your tax bill. So $1,000 credit saves you a full $1,000 in tax versus a percentage. And the control that you have over that is low because the IRS sets specific requirements and says, hey, in order to capture that credit, if you want to capture that credit, you got to meet certain criteria. You got to do certain things or be eligible for that credit. So tax credits are not as controllable, generally speaking, by the business owner. Okay. The next thing that we want to kind of broach here is let's talk about some like TikTok tax advice, right? And do a little myth busting. So a myth, people say, oh, I need an LLC to write things off in my business. That's not true. The reality is you can absolutely deduct ordinary and necessary expenses, just like an LLC, just like an S Corp. LLCs are more legal liability and separation, not necessarily tax magic. You're not magically taxed differently when you have an LLC. Now, if you make the S Corp election, and there's a whole module around that inside of our Launchpad series, but the S Corp election can change that for an LLC, but we'll talk about that different time. Okay. Another myth is if I claim expenses, I'm going to trigger an audit. Well, the reality is no, deducting legitimate or documented business expenses, that's the IRS expects you to do, right? They say, hey, if you're out servicing your clients and if you're a refrigerator repair person, right, you're gonna have mileage. I had somebody come repair my fridge the other day. So there's mileage, there's tools that person has. If they pay for the parts and then charge the customer for the parts, they incur the cost of goods sold, right? So businesses are expected to have expenses. It's not a bad thing. You want to be aware of the expenses and what you're spending, which goes back to being organized and understanding the inflow and the outflow. But at the end of the day, business expenses are fine. When it comes to write-offs, like, okay, people say, hey, the myth is, well, write-offs are just free money. I have that, I get to take it as a write-off, so that's free money. No, that's actually money that you're still spending. Like you still got to pay for the thing out of your income, like your gross income. So it does lower the income that you're taxed on, but you're still paying for that expense, right? Business deductions versus the standard deduction, right? Business deductions, and this graphic is really designed to be, here's your business. So business write-offs on the Schedule C or your business are reported on your Schedule C, your LLC, your S Corp, and all those do is reduce your income. So business deductions and the standard deduction are two different things. People say, well, should I itemize? If you're saying, should I itemize for your business? You should always itemize and keep track of the details. If you're talking about itemize for personal, you're saying, should I itemize over the standard deduction? And the IRS gives you every year, it's adjusted for inflation, and that standard deduction goes up. But if you're single, you get a standard deduction. If you're married filing jointly, you get a standard deduction, or if you're head of household. So there's different standard deductions. Pretty much everybody gets the standard deduction. The business deductions are specific to your business and what you spend. So those are two very different things. Kind of going over some basic stuff here, but it's good to understand this. Record keeping when it comes to business expenses, right? Digital is fine. I say in the digital world, you really just want to keep things forever. Like there's no real reason to say I'm going to get rid of them after a certain period of time because they take up so little storage space, and you can have digital backup. But receipts for large purchases, mileage logs, credit card statements, invoices to clients, 1099s, prior year tax returns, like meal documentation and the business purpose. All these things are phenomenal to keep digital. Should you toss it and reduce the clutter? If you're keeping a shoebox of every single receipt, I mean, digitize that stuff, right? Paper copies, if you have it digital, you can get rid of those. Documents that don't provide any detail, you should keep things that provide detail about what you bought, why you bought it, and the purpose. And as a general rule, you want to keep documents 3 to 7 years, unless they're digital, and just keep them forever. A pro tip, avoid anxiety and overwhelm by developing habits to handle your record keeping on a regular basis. And I like to gamify this. So, there's admin hours. You can say, hey, I want to host, you can network with other people. I want to host a admin hour, and we're going to get together at Starbucks. We're going to get together at my house. And for the next hour, we're just going to jam some music and just work in awkward silence, right? Find somebody that you can do that with, to hold you accountable, and gamify that and say, okay, whoever is in my group, hey, whoever's the furthest behind on logging their receipts, buys coffee today, something like that, where you can keep on a regular cadence. That's the biggest defense against overpaying in taxes, is record keeping and getting organized, which is why it's one of the key pillars of the Make Taxes Fair, Clear, Edge framework. How often should you purge, right? The audit decay rate and the 3-year rule. So 3 years from the filing date, you can confidently say, hey, I don't need that information. There's generally a statute of limitations on most things, where it's 3, that's why they say 3 to 7 years. If it's from the filing date. Again, my personal opinion is digital is forever, properly backed up and password protected. So I just say digitize and keep confidence, so you be able to sleep well at night. We're going to talk a little bit about some of the big 4 expense areas. So the home office deduction, vehicle deduction, meals, and travel. And the reason why we're kind of hitting on these are some of the most abused categories when it comes to business expenses, and some of the most highly audited areas. Now, keep in mind, this is a high-level primer. We're not going into massive detail on these. We'll do that in future recordings, but let's get kind of a high-level overview here. So the home office, the golden rule, the thing you got to remember, folks, is it's got to be exclusive and regular use. Used consistently, 100% for business, with 0 personal use elements. So if you have a home, and this question came up with a content creator that we're working with, right? He does content, he does filming in his kitchen, in his bedroom. He does filming in the bathroom. Like he demonstrates home products. So he's like, hey, check this out. This is amazing. I'm gonna scrub the tub. Look how clean that got that. So he's using his home to film products to get people to buy things on TikTok. Cool, right? Well, the home office, it has to be 100% business, exclusive, and regular use. So, even though he's filming in the kitchen area and the bedroom area and the kitchen and the bathroom, if you got to have that exclusive home office usage. So the portion of the home really can only be what you use exclusively. So that's the rules. Now, there is a calculation that you can do. You can take a simplified method. It's quick, easy, came into effect a few years ago. So basically, you can say, hey, a flat $5 per square foot up to 300 square feet. So going back to this graphic here, you can say, hey, here's the measurements of that office, that dedicated space, that home office. Cool. We could take the measurement and use the flat $5 per square foot method. That's cool. Easy peasy. The actual expense method can be a higher value depending on, portion of your rent, your utilities, insurance, internet, etc. Right? But you just have to determine what methodology do you want to use. You can flip-flop back and forth. If you own your home and you're doing actual expense method, just keep in mind that depreciation recapture for the business use of your home can come into effect. A lot of people miss that. Whereas the simplified method just kind of skips the whole depreciation recapture period. But again, keep in mind, it's got to be exclusive and regular use. Use 100% for business, Zero personal element. That's the kicker, and that's where people get nailed when it comes to the home office is record keeping as well as exclusive and 100% use. Vehicle deduction. So the home office loophole, right? If you have a qualifying home office, meaning it's your principal place of business, you don't necessarily have another office that you go to, then all trips and everything can be 100% deductible, right? Because you're going from home, which is your home office, but generally speaking, commute is not deductible. You're commuting on a regular basis to a client. Hey, that's a thing that I'm commuting to that person. That is generally considered your commute. Again, the home office loophole can change that, but you got to document that really tightly and make sure that you're documenting your mileage and your ride. But then if you go from client A to client B and to C and throughout your day, generally speaking, your last client of the day and home is considered a commute. So there's a lot that this is where the IRS trips people up is A, they don't have good records, and then B, they don't keep they don't clearly define like here's where I'm going and why. So the record keeping is really, really important. And folks, I hate to say this, there is no substitute for the hard, boring work. There's tools and apps. I like Mile IQ, great app. It does one thing really well, which is track mileage, but there is no substitute for that, the doing that work. The question that comes up all the time is, do I really need to track miles? The short answer is yes, and here's why. If you're taking the standard mileage rate or the actual expense rate method, if you're taking the standard mileage rate, you got to track the miles and say, hey, these are the miles I drove for business. Okay, that makes sense. If you're taking the actual expense method and you're tracking everything, you're saying, hey, gas, insurance, blah, blah, blah. At the end of the day, the IRS still says, hey, you need to track business. Now, there's an exception to that. I had a fellow once. He was a welder. He had a portable welding rig on the back of his truck. Guess what? He didn't do anything with that truck other than go to the work site, go to the job site. He was a mobile welder, so he would go to clients, weld their fence or weld their, whatever project he was working on. Come home, and he was paranoid. He'd lock that sucker up in his yard because he was afraid that his stuff was going to get stolen. He didn't go to the grocery store. He didn't take that to the movies. If it's a clear like, hey, this is only used for business, you still should track your miles. You still should, but the fact that it's 100% is easier. If I'm a real estate agent and I'm hopping in my Tesla and I'm jamming out to meet clients, or if I'm a sales rep for farm equipment, right? Have a client that's doing that. That vehicle, I could pop the kids in, take them to soccer on the weekend. That is not 100% business use. So it's important to understand that and I don't mean to harp on this, but the IRS really does want you to track your miles. They want to say, hey, how are you? That's how we determine the business percentage. Okay. Business meals. So the 50% rule. So you go to meal, you have a qualifying meal that is tax deductible, spend $100 with tip. Guess what? Only 50% of that is tax or tax write-off. So the 50% haircut automatically applies. And to be completely audit proof, you gotta have documentation. Who is that meal with and what was discussed? What was the purpose? Guys and gals, to be defensible, you gotta have a business purpose. You gotta document to survive an audit. Lunch with a potential client, great. Coffee with a referral partner, great. Frequent lunches, like things that you should not deduct. Hey, taking myself out to lunch every day, not gonna fly. I check emails while I'm at lunch. Okay, you could do that from the office, right? That's fine. Or grabbing dinner on the way home, saying, "Oh, I don't have time to feed my family, but it's a tax write-off. I'm gonna just grab dinner on the way home." That doesn't fly. It's got to be a legitimate business expense. Now, if your spouse is part of your business or your kids are part of your business, and you're going to dinner, once a month, every other week, cool. Like, did you legitimately talk shop and business, and can you say, hey, as a result of us going to dinner, we broke bread and we had a conversation that helped the business. If it's like every night or 3 nights a week, that's not going to fly. Remember, pigs get fat, hogs get slaughtered. Travel and wrapping the weekend, right? So here's a great way to potentially uh, capture travel and more business. So more business write-offs. So if I have a business day, if I'm going actually out to a conference, and I said conference call, that should be just a conference. So I'm here for a conference. I fly out Thursday, roll in Thursday, and kind of go to dinner and do my thing. Friday's the conference. Saturday, Sunday, if I have business on Monday, I can take the weekend, and that weekend is fully deductible, right? So I can go parasailing, I can go hiking, I can do some fun things. I could go to Disneyland, and Disneyland is not tax deductible. The parasailing activity is not tax deductible, but the hotel and the meals while I'm there, because I've got to be cheeks in the seat on Monday for a client meeting or conference or whatnot. So these bridge weekend time can be tax deductible. And then I fly home on Tuesday, right? What type of work qualifies, right? So you really need to be aware of the work during travel. You're not checking emails, you're not taking phone calls, folks. You can do that from home, you can do that from your regular place of business. If you're gonna survive an audit, you really need to say, hey, I was there to meet people, they came, or I was there to meet a client, I was doing a site visit. You got to have a legitimate reason to say, hey, I had to be in the Maldives, right? Not going to the Maldives, but you could potentially. We'll dive into that in a deeper conversation later. Exclusions: if you have a non-working spouse or family, right? You can't. Your hotel, sure, they stay with you. Their plane ticket, if they're not part of your business, their plane ticket is not deductible. Their meals are technically not deductible, right? So you have to be cognizant of that. They have to be an active participant in your business. And then the 4-hour rule is something that a lot of people don't realize that applies. Like, you don't have to do a full day of work. I've been to conferences where it was a half day on Friday, and then they cut us loose at noon and said, hey, go have fun. We're in Puerto Rico. Go check out, go hiking, go see the city. Saturday, Sunday was off day. Monday was back in the saddle, 4 hours, and then Tuesday, 4 hours. So we got a 12-hour conference, but they intentionally structured that conference to be a minimum of 4 hours Q&A. You can stick around for an hour or so after that, but they're like, hey, you're here, go have fun. Like, we're here to have fun as well as work. So as long as you're doing legitimate work that's not can't be done from home, that can qualify. Examples of deductions: 1099 or real estate agents, mileage to showings, right? MLS dues, license renewal, staging photos, E&O insurance, broker's fees, marketing, right? You can see all these are ordinary and necessary for that field or that niche, and related to their business. Consultants, software subscription, travel to clients, professional development, website hosting, marketing, business insurance. Content creators, camera equipment, lighting, props, dedicated home office, editors and software and marketing. So, all of these are legitimate business expenses that you can deduct and write off, right? So coming down the stretch here, the rules of keeping it separate. Many business owners, if you're a sole proprietor, you're not legally required to keep it separate, but it just creates a accounting nightmare. And you end up possibly deducting things that you shouldn't. So, the mistake of not keeping things separate can really cause some headaches. So I advocate to say, here, create some consistent habits and make this thing work, right? Be organized, pay your business expenses out of the business account, transfer yourself money out to pay for personal expenses. Your ticket to getting organized or optimizing your deductions is really getting organized, right? If you're keeping your records on spreadsheets, that's a recipe for chaos. QuickBooks and other tools save time. Be consistent. Good habits beat last minute rushes. So eating an elephant, or when you say eating a buffet or a feast, you eat it one bite at a time. You don't try to shovel everything in. And then I'm a huge advocate for find the right who. The highest and best use of your time is not being a bookkeeper. The highest and best use of your time is running your business and doing those higher value things. So find the right professional that can be the who, so you don't have to figure out the how. It's a great book, by the way, Who Not How. Um, if you like this, check out more stuff like this in maketaxesfair.com/community. And remember, friends don't let friends overpay the government, folks. If you found this to be helpful, if this was blessed your life in any way, share with a friend. We are grateful for your time being here. Thanks so much, and we'll see you in the next video. Bye for now.